Okay, fun seekers, have we got a treat for you? We are going to slog through a typical Form 1040 tax return for the average homeowner. Yeah, I know, it's a little tedious, but it's really not that hard once you've done it a few times. As we've asked you to do in the previous presentation, it's a good idea to print the first tax exercise. There are 2 pages, and then the Schedule A for the first tax exercise. You don't have to. You can bounce back and forth on your screen, and I will do that. But the problem is it winds up being very, very small on your screen, and it's those of us with not the best eyesight would be well served to have a printed copy. So let's get started. The top half of the Form 1040 concerns our identification information and our income. So I'm going to put that on the screen, and again, it's going to be a little difficult for you to see if you're just looking at this on your phone. But here we have an individual tax return for A King Back. A King Back. Yeah. See what you're missing in the face-to-face class? A King Back, and we put his Social Security number down, and we made sure we put the Social Security number down, because if we don't put the Social Security number down, that makes it very difficult for the IRS. Plus, they get nasty, they get angry, and I don't blame them. People used to, and probably still do, put in the margins, IRS sucks, taxes are unconstitutional. One guy, many years ago, it was a 1040EZ, but he sent it in on the back of a T-shirt. So the IRS went to the Congress and said, you know what, we're tired of this. We're people too, kind of, sort of, and we don't want this to happen. So now there's a penalty, a fine for a frivolous or nuisance return. So make sure you put your Social Security number down. Make sure you sign it. Don't put nasty things in the margins. Yeah, okay. You put down your address and whether you're outside the United States or not, and then whether you want any money to go to the presidential election campaign, which you don't, because that's sort of an anachronism. Nobody uses that money anymore, because if you do, then you as a presidential candidate, you forego, you say you won't raise a certain amount of money privately, so they don't use that money anymore. So most people don't, just say no. Now, what's the filing status? For A King, he could be single, but in his case, he has a dependent. So he puts down head of household. Now, as we said in our previous presentation, he has to be the one who is giving 50% plus 1 of the dependent's care. So if there's a child from a marriage and both parents can't be head of household. And if you do choose head of household, then you have to put down who your dependents are, or in this case, just one dependent. And who is this? This is Wayne. Wayne-de-back. Wayne-de-back. Yeah. And he needs his Social Security number. Yes, they do. They ask for the Social Security number of the child or the dependent. Why? Well, that's a very good history story, a very good lesson. You see, the IRS didn't used to have the Social Security number required on the 1040 form. And then one year they decided they were going to require the Social Security number. And in that year, 8 million children disappeared from the United States of America. Would any American cheat on their taxes? Oh, no, only people from Chicago countries do that kind of thing, right? Yeah, right. And then we totaled up the number of dependents and individuals in this tax return, and we see that there are 2. That's pretty easy, right? You can do that. Good. And then the rest of the 1040 form on the top page of page 1, the top of page 1, is now concerned with your income. Here is where we put our income. Well, the vast majority of folks are only going to have wages and tips and salaries line number 7, and maybe some taxable income. And that's exactly what we see with A. King. He has wages and salaries and tips from his W-2 form of $51,900 and taxable interest of $100. Does he have alimony, business income, capital gains, IRA distributions, farm income, and employment compensation? No. And maybe you'll have one or two of these things, and then it can get tricky. I mean, if you have a business, then you have to do Schedule C, which is the income and expenses for the business, and if you have a farm income, you need Schedule F. So yeah, it can get very quickly difficult depending on your situation. But for the vast majority of people, no, this is going to be pretty straightforward. They put in their salary, they put in any interest they might have received, maybe some dividends from a stock or a mutual fund, and then they total that up on line 22. And if we go back to the presentation, that's what we see here. Income is the top half of page 1. Wages, interest, investment returns, business profit, real estate profit, pension fund income, and the like. And we put that number on that total on line 22. The next part of page number 1 are the adjustments. And again, for the vast majority of people, they might have one or two adjustments to income. Now, these are not deductions. That's on the next page. These are called adjustments. And in A. King's case, he's put money into an IRA, $1,000 into an IRA, and he's paid $1,000 of student loan interest. But notice there are some that you won't even use, reserved for future use. You like that one? The IRS says, hey, don't use. Somebody might put a number there, and they'll say, no, that's not a, who knows what happens. Educator expenses, kindergarten through 12th grade. Teachers can deduct some of their expenses. Health savings account adjustments, self-employed plans, and the like. So this, if you're one of these people who affects, you would put that number there, but the vast majority are not going to put anything. And so what we see is, in this case, A. King's is putting $1,000 into an IRA, and he paid $1,000 in student loan. We put that number, the total here on line 36, 2,000, and then line 37 gives us our adjusted gross income. We take the total income, subtract the adjustments, the total of the adjustments, and we get our adjusted gross income. And what do some people do? They add them. Right. The IRS says that most audits are just because people did the wrong thing. Instead of subtracting, they added, or vice versa. So that's what, if we believe the IRS, that's the problem. That's what happens. And so that was slide number 13. The adjusted gross income on the bottom of page 1, and we'll see it then gets moved to the top of page 2, is a very important number. Many tax items are tied to the adjusted gross income, such as the ability to contribute to retirement accounts, utilize certain deductions and personal exemptions. We'll just see that in just a little jiffy. So now let's take a look at it again from a different perspective. This is the exact same thing we just discussed on slide 14. We just show it a little bit more along the lines of what the 1040 form looks like. We take earned income, business income, investment income, whatever, and that gives us a total income, gross total income of whatever it is on line 22. We then take any adjustments to income, retirement contributions, alimony paid, student loan interest, and the like, and we get total adjustments to income. We then subtract the total income minus the total adjustments and get adjusted gross income. Piece of cake? Okay, good. Because now here's where it's going to get a little tricky. Let's go back to the 1040 form and go now to page number 2. You'll notice that we take the adjusted gross income from line 37, the bottom of page number 1, and we move it to page number 2 at the top. The next line, well, then 39. 39 is for people who are over 65 years of age or blind. So we'll leave that out. And what that does is that just gives us a little bit more of a personal exemption, but we're not going to deal with that one. But if you're over 65 or blind, you would click those boxes and get a little bit more back from your taxes. But here's here's where it starts to get a little tricky and confuse people. Line number 40 is one of two things. It is either your itemized deductions or your standard deduction, but not both. And this is where people start to go, huh? And they start to turn their thoughts somewhere else from the discussion because they don't want to think about it. They just tune out, so to speak. But it's not that hard, folks. Everybody, just because you're breathing, gets a standard deduction. And the standard deductions change over time. But currently for 2017, if you're single, they're $6,350. And if you're married or a qualifying widow or widower, they're $12,700. If you're head of household, notice they're in between, $9,350. And this is why you probably want it printed out, because some of you probably couldn't even read what I just highlighted. And so since A. King is a head of household, you would think he'd put down the standard deduction of $9,350. But no, he put down $19,000. So what's happening in his situation is he is taking advantage of itemized deductions. You see, you get to either take the itemized deductions or the standard deduction, but you can't take both. And it's in your best interest to take the higher number, the larger number. So if the itemized deductions were less than your standard deduction, you wouldn't bother. You would just go ahead and use the standard deduction. But in his case, his itemized deductions are larger than his standard deduction, so he takes the itemized deductions. Is it making any sense? If not, go back, rewind it, and take a look, because that's going to reduce his taxable income and hence reduce his taxes. So it makes sense to make that as large as possible, right? Now, can you just throw a number up in the air and say, ooh, this is how much my itemized deductions were? No, you can't do that, folks. You have to itemize. You have to list, enumerate. You like that word? I like that, enumerate. You have to write them down. And where do you write them down? On Schedule A, the homeowner's friend. As we'll see, this is the friend of the homeowner. Now, things are changing a little bit in 2018, but we're still doing 2017, so we'll keep doing it. And this is where you itemize. You list all your deductions. Now, notice that there are several sections in Schedule A. And in A. King's back, he left the medical and dental expenses empty. Now, he's got a child. Is it realistic to believe he didn't have any medical expenses? No, it's not realistic. But here's the kicker. You have to have at least 7.5% of your medical expenses that let me start over again. I'm going to confuse you. I apologize. You have to have at least a certain amount of medical expenses before you're allowed to deduct medical expenses. Huh? What's going on here? Well, remember the adjusted gross income? His adjusted gross income was $50,000, and that's why you see enter your medical expenses. Okay, great. I can do that, IRS. Now I have to enter the adjusted gross income here underneath the medical expenses in line number 2. Huh? Why? Because then I'm going to multiply that number times 7.5%. And that turns out to be $3,750. Do it. Multiply $50,000 times 7.5, 0.075, and you'll see that's $3,750. And so your medical expenses have to be at least $3,750 before you get to claim them. Anything above that, we could put here on line number 4. But if it's not above that, you put down 0, which means you don't get to deduct anything. Did that make any sense? If not, go back, listen to it again, and if I didn't do a very good job, I apologize. Contact me, but I'll say it again. Your medical expenses have to be at least 7.5% of your adjusted gross income before you get to deduct any of them. And that's why A. King left it blank. He didn't have $3,750 of medical expenses. But now we do, in 2017, get to deduct either our income taxes or our general state taxes, plus our real estate taxes, personal property taxes, and this is part of the changes that were made in December of 2017 to the tax code. The Republicans limited that amount to $10,000. Very controversial move because that affects mostly Democratic states: California, New York, Chicago, the Illinois area, the big cities back east. So we're going to see that play out over the next couple of years because the governors of those states, the legislatures of those states, are not too happy about that. Yeah, okay. So he had $1,000 in California state income taxes, plus his property taxes on his condominium, $2,900. And then the DMV tax, the vehicle license fee, was $200. And you add those up and you get $4,100. Now, is that enough? Remember, his standard deduction was $9,350. No. So that's not enough to go over the standard deduction. What's going to put him over the standard deduction? Right. His home mortgage interest. Exactly. And that's why we call Schedule A the homeowner's friend. Because if you own a home in Southern California, you're paying tremendous amount of interest, and you're getting to use the Form 1040. You're getting to itemize your deductions. And as we said, the tax cuts of December 2017 are controversial because this now has limited it to the first $750,000 of mortgage. Right. And certainly yes, exactly. Some people have mortgages that are higher than that in California and New York and Boston and Philadelphia, where I'm from, and Washington, D.C. and Chicago. So here, A. King gets to deduct $14,400. Wow, that's a lot of money. Later, we'll discuss mortgages later. And so he puts that, now he's over. He puts that on line number 15. Now he's over the standard deduction of $9,350. He also gave $500 to his church or KPBS or Southwestern Community College Foundation because we're a 503c IRS-approved charity, nonprofit organization. And he puts that here on line 19. And so let's move down a little bit. Okay, line 19. We put that there on line 19. Now, what about casualty and theft losses? No, we didn't have any of those. What about these job expenses and certain miscellaneous deductions? Well, here's where you put down tax preparation fees, union dues, employee expenses that were unreimbursed by your employer, such as uniforms and the like. But he didn't put anything here. Why? Because, again, like the medical deductions, you have to have at least 2%. Here, after you've added all these up, where we put down our adjusted gross income, they don't tell you it's the adjusted gross income. They just tell you to grab line 38, the adjusted gross income, and then multiply it times 2%. So, again, in A. King's situation, his adjusted gross income is $50,000, which means he would have to have at least $1,000 worth of these miscellaneous expenses before he could actually deduct them. Right, so he leaves it blank. And the total is $19,000 as the number that we put back on the 1040 form. Now, do we have to send in all the receipts? Do we have to? No, we don't. We can. They don't care. But if they don't believe that you gave $500 to your charity, they might send you a letter saying, please send us a copy of the form that was given to you by your church or whatever. And so you do need to save all those receipts and the like. Well, make sense? Yeah, but you don't have to send them in. And in the case of your mortgage, they already have that because the mortgage company sent that to the IRS. They sent that to the IRS. So the little snitches told the IRS how much you paid it, which in this case is good, huh? Okay, so let's go back now. So you saw how to enumerate, how to itemize, how to list all your deductions. So let's go back to the 1040 form, and we see that indeed there's the $19,000. That's right there. We then subtract 50 minus 19, and we get 31,000. So that they don't have a name for that. They just say subtract line 40 from 38. It's a subtotal. Now the personal exemptions. These personal exemptions are going away in 2018, but they're still here for 2017. For every individual in your family, you get to deduct $4,050 from your gross income, from your income, your taxable income, and that lowers your taxes. And it's a little bit more if you're 65 or older or blind, so that's what that line 39 was for. But for most people, it's going to be $4,050. Now notice that if your adjusted gross income is over a certain amount, in this case $156,300, I can't see it myself, it's gotten very small, then the personal exemptions start to phase out, right? So again, it has that AGI, that adjusted gross income, is very important. But the vast majority of us are not going to have that problem. So we subtract $8,100 because there is a king and his son Wayne in the family, and we wind up finally on slide 44 with $22,900. Whew! Yes, I know. That's why I use the term slog. It's a slog, folks, and that's what these next couple of slides are going to show us. How we just got to that number. We take the standard deduction or the itemized deductions, but you can't take both. And we get to deduct the personal exemptions. And as we said, it's a great source of confusion for many people. Everyone gets to claim the personal exemptions unless your adjusted gross income is too much, and then they phase out. And as we said, they're being removed in 2018. Slide number 16 is exactly what we just went over again. Adjusted gross income minus itemized deductions or minus the standard deduction minus the personal exemptions in both cases gives us the taxable income. Whew! Wow! It took us all of page 1 and the top of page 2 just to get to the point to know how much taxable income we have. And once we have gotten that number, now we're ready to go into the tax tables, which most people are going to use up to $100,000. So here, dear students, are the IRS tax tables for 2017. Now, I don't suggest you print this out because it's many pages, 16 pages or 15 pages, but you can look at it. It's on the website and it's on the IRS website itself. So let's go down. What were we looking for? 22,900? I forgot already. Yeah, it was 22,900, right? So we start off, here's, it was $1,000, 2,000, 3, 22,900. Okay, here we go. 22,000. We get 22,000. Now I'm going to make this a whole lot bigger, and hopefully we won't lose it. Yeah, here we are, 22,000. We have to go up here and notice which filing category. Well, he's in head of household. Here's single, married filing jointly, married filing separately. And so we go to 22,900. Here's 22,900 here. Here's 22. Which one do we use? Well, it turns out we got to go back up and see at least but less than. Right. So we have to go to the next line. If it had been $22,899.99, we could have used this row right here. It's not highlighting well. I apologize. But because we just hit 22,900, we have to go to the next row, and that's 22,771. And people, again, when they see this, they go, ah, look at all those numbers. Ah, I'm scared, I can't do it. It's not that hard, folks. You can do it. It's a table lookup. It's not that hard. So 22,900 was his taxable income, and the taxable income is what we use to compute our tax due for the vast majority of people. Because you'll notice if you go all the way to the bottom, you'll see that these things end at 100,000. Then you have to use the tax schedules. And if you're that high, folks, buy TurboTax, and it's pretty easy to do because it'll do the calculation for you. Or contact me or a tax professional who you'll pay. And some of them are worth their money, folks. Some of them are not. We'll discuss that in the next presentation. So we went into the table, $22,900, and we came back with our tax due of $2,771. And that's what we described here on the slide number 17. We use taxable income to compute our tax due. Either the tax table up to $100,000, tax rate schedules if it's over $100,000, or one of the few other methods, but most people are not going to be affected by that. Then we need to understand our marginal tax rate. The marginal tax rate is the rate used to calculate the tax due on the next dollar of taxable income. You see, the tax rates for 2017 and prior were 10%, 15, 25, 30, 28, 33, 35, and 39.6, and they have now gone down for 2018 from the Republican tax cuts of December 2017. And then we'll calculate the average tax rate, which is not as important as the marginal tax rate. It's easier to understand, but it's also it is important when you want to discuss tax policy and to debunk the flat tax advocates, who I guess have been basically ignored by the Republicans, so I guess they've been thoroughly debunked by everyone now. So let us take a look at the marginal tax rates. Now what am I talking about, folks? Remember we went into the tax table? Well, the marginal tax rates are built into the table. You don't have to calculate them. They're done for you, but you still have to understand them, at least as far as Business 121, Financial Planning and Money Management. But no, it is in your best interest to understand what's going on here. You see, for 2017, the first $9,325 that you earn as a single taxpayer. Now remember, this is after your deductions. This is after your standard deductions, after the personal exemptions. That's taxed at 10%. From $9,325 up to $37,950, it's taxed at 15%. From $37,950 to $91,900 is taxed at 25%. The more money you make, the next dollar is taxed at a higher rate. Now, they don't go back and recalculate the first $9,325. They don't go back and tax you again. You're already taxed on that amount. It's the next dollar. That's why it's so tricky. And of course, if you're married, there are two people, so they double it for the 10%, double it for the 15%, but not for the others, and we'll discuss that later on. From 2001 to 2012, the tax rates were temporary, and they adjusted them every few years. But after the fiscal cliff fight at the end of 2012, they became permanent until the end of 2017. The Republicans have now made them temporary again, and they are going to be repealed, or I guess they're not repealed because they're temporary, so I guess you can't repeal them. They'll just go back to where they were at the end of 2025, but the Republicans have vowed to make them permanent by then. I don't know how they're going to do that. They say... Let's not get into politics now. We already said our piece, right? So take a look at this. Take a look at this number. 0 to 9,325, 0 to 18,650. What happened in 2016? 9275, 1850, 18,550. You see, the percentage rates normally, they did this year, but normally the percentage rates, the 10%, the 15, the 25, they don't change. The tax brackets are simply adjusted upward according to the inflation rate. The 2015 brackets were lower than 2016, 2014 lower than 2015. And why is that? If that weren't the case, folks, if they did not adjust the brackets according to inflation, then as your wages go up, you would start to get higher taxes just because of inflation. Now, if your wages go up because all of a sudden, you're more high-powered and you've got a huge raise, then that's okay. Then you're according to the theory behind our system, the more money you make, the more you pay. Now, if just because inflation goes up and people are getting a cost of living adjustment, then if the brackets were not adjusted, then we would be having higher taxes just because of inflation. So the Congress fixed that, I don't know, 30 years ago or so. So that's a good thing, in my humble opinion, and most people's humble opinion. What kind of tax system is this? It is called a progressive tax. The more money you make, the more you pay. And the idea being is, look, once you're in the 100,000, 200,000, or 300,000 or more, you've already paid for the milk and the rent and the shoes. You can now afford to pay more in taxes. There are some people who believe that this is wrong, that we should not have a progressive tax system. And again, these are societal issues and political issues and cultural issues and economic issues that need to be worked out by society. Personally, I think it makes a whole lot of sense. But then again, I'm a liberal, elite college professor who happens to be a stockbroker and a real estate investor and believes in the horrible, radical idea of what you do to the least amongst your brethren, you do to yourself. But that's I apologize. No, I don't. But this has become it's become a situation where people are no longer listening to one another. We're just screaming at one another, and so let's hope we can someday, dreamer, become nice to one another. Now, what has happened? Right, slide 20. What has happened is that the Republicans have pushed through their tax cuts. Again, very politically motivated, very divisive, and look what's happened to the rates. Remember, it was 10, 15, 25. Right now, it's 10, 12, 22, 24, 32, and so the rates have gone down, but only until 2025. The December 2017 tax cuts will give the average poor family a tax cut of $60. The middle class will see an average tax cut of $930. Not bad, right? Folks in the 95th to 99th income brackets will get about $13,500 back. And the top 0.1% will see an average tax cut of $193,380. And so when they get up and say that this is not going to benefit the rich, it's going to benefit the middle class, I just have to say, no, you're wrong. You're lying. It's not the truth. And once the plan is fully phased in, taxes go up for the bottom 40%, will remain unchanged for the middle 40%, go down slightly for the 80 to 99% range, and fall sharply for the top 1%. And so, whatever slings and arrows from you Fox News fans do throw at me, but I'm showing you what the numbers say. Yeah. Slide 21. Let's go back to 2017 now and compute that tax using the marginal tax rates. And again, this is all built into the tax table, so we don't have to do this. But if this person, this is not a king, this is somebody else, made $38,950 of taxable income, again, after the adjustments have been removed, after the standard deduction or the itemized deductions and the personal exemptions, and you're on line 43 and you have $38,950 of taxable income, and you're single, the first $9,325 is taxed at 10%. That's $932.50. Between $9,325 and $37,950, that's taxed at 15%. So how do you calculate that? You take the $37,950 minus the $9,325, and you multiply that times 15%, and go do it. Make sure I got it right. And you get $4,293.75. Now, because this single person made over $37,950, they now move into the 25% tax bracket. And notice I picked that number purposefully to make it come out even to 1,000. $38,950 minus $37,950, and you multiply that times 25%, and you get $250. Add those three up, and you get $5,476.25. And if you go into the tax table, you'll find that it's close to this. It's not exactly this, because the tax table works on $50 increments. But do you understand now? The next dollar you make is always taxed at your current marginal rate, which is why it's important to know that marginal rate, so that you say, okay, if I make this much more money, I'm going to pay this much more in taxes. Now, can you do anything about that? Maybe, probably not. You probably don't want to not make that extra money, but so you understand that you're going to be taxed at that rate. And if this individual had reached $91,900 in 2017, they would then move into the 28% bracket, 33, 35, 39.6. You understand? If not, go back and read it again. Contact me if you're having questions. I know it's a little tricky, but not really once you've done it a few times. Slide number 22, the average tax rate. Well, the single taxpayer from the previous slide had $38,950 of taxable income and $9,476.25 of taxes due. Therefore, their average tax rate is the $5,476.25 divided by the $38,950, or about 14%. So even though they've moved into the 25% tax bracket, because the lower tax brackets were taxed at a lower rate, their average tax is about 14%. And this is where the flat tax advocates fall down in their argument. They say everybody should be taxed the same. Well, if we would do that, it would mean that they usually throw out a number like 17%. It'd actually be about 20%. So who would win? Who would lose? Again, the rich would win handsomely, and the lower classes would lose in a flat tax. And the flat tax advocates say, well, wait a minute. We'll shelter the first $20,000 worth of income. For single people, the first $30,000 of married. So you see, they've added some progressivity to their flat tax argument. Okay, let's talk. And then there are others who say, no, we shouldn't have any tax on income. This was me 30 years ago when anybody would listen to me. Nobody listened to me, so it didn't go through. They call it the fair tax. They want to get rid of income tax, and they want to replace it with a sales tax, a value-added tax, some other countries call it. Because you don't want, this is my humble opinion, you don't want to tax people on their income. You want them to earn as much money as they can, because that means they're being productive. That means they're contributing to the society. They're contributing to the economy. You want to tax them when? When they spend, a consumption tax. And then the argument is, well, then that's regressive because it hurts the poor. Okay, make the consumption tax less on important things like shoes and milk and make it higher on luxury items. There's room for discussion, folks. I don't know if you remember Mr. Kane, who ran in 2012 and got shot down because of sexual picadillos, but his plan was he called it 999, right? 9% value-added tax, and 9% capital gains tax, and 9% income tax. So we can discuss it. No, we can't. Give up, Piano. I hope you believe that eventually we will fix the tax code and we will make it fairer and more equitable and pay for the pay for the streets, pay for the roads and the schools and the aircraft carriers. What a dreamer. Let's continue. Slide number 23. The marriage penalty. What? If the marginal rates are higher for single taxpayers, how come we sometimes hear people complain about the so-called marriage penalty? Well, because the second wager in the family pays their taxes at the highest marginal rate, they don't get to take advantage of the lower tax brackets. Married couples with only one wage earner get rewarded, not punished, but they're two people, they need more money. What are we talking about? Let's take a look at the first two brackets. Notice that 93,25 is half of 18,650, and 37,950 is half of 75,900. So the Congress removed the marriage penalty for the first two brackets in 2003. But notice, 9190 is not half of 153,000, and 191,650 is not half of 233,000. So as you go up the ladder, so to speak, as you move into the higher tax brackets, the marriage penalty affects you. Because say you're making $200,000, which, congratulations if you are, you're in the you're married, you're in the 28% tax bracket. Now, if your spouse decides to go back to work, or if he or she has already been working, their salary is now taxed starting at 28%. You see, and this is why sometimes people, if say one of the spouses has been staying home and raising the children, and the other spouse is the primary breadwinner, so to speak, and now the second spouse says, you know, the kids are a little older, I think I can go back to work. They think they're going to make a whole lot more money. Yeah, but they're also going to be taxed at a much higher rate. And of course, because you are having two spouses out of the home working, the expenses are going to go up. You know, maybe a lot more food prepared as opposed to being food bought as opposed to being prepared in the home. More commuting costs, childcare costs. So they often find that they're not making as much money, or should we say they're not taking home as much money as they thought they were. So that's the marriage penalty. Slide number 24. So let's go back to we don't forget we still have our 1040 form. Let's go back to the 1040 form and look at line number 45, the alternative minimum tax. Notice it's empty for A King. What is the alternative minimum tax? Well, the alternative minimum tax, the dreaded alternative minimum tax, is the system that was designed back in the late 1960s. It was originally meant to make sure everyone who could afford to pay taxes would pay some taxes. Why? Because in the 1960s, accountants and lawyers started to become very creative, and very wealthy individuals were not paying a dime in taxes. Well, when that got out into the mainstream media, people were understandably upset and contacted their elected representatives, and the Congress created the alternative minimum tax. But the problem with the alternative minimum tax is it was never indexed to inflation. So in the late 1960s, $100,000 was a very unusual and substantial income, folks. But now, it ain't bad, don't get me wrong, but it's not what it was when a house cost $12,000 and a car cost $1,600. It is a very different world back then. So the AMT will continue to affect more and more the middle class as wages climb with inflation, especially two-income families. In the 2017 tax cut bill, it was eliminated for businesses, but not for individuals. Slide number 25. Are you still with us, folks? Relax. We're getting near the end. Tax credits. There are various tax credits. Now, folks, tax credits are very, very cool. They are amounts subtracted directly from the amount of taxes due. There are taxes for foreign taxes paid if you worked outside the country and had to pay taxes to that country first. You don't have to pay them again to the United States. Education credit, child care credit, child tax credits just because you have a child, retirement credits, energy credits. Now the earned income credit's a little different. That goes a little bit later. But these are on lines, what is it? Let's go back to the lines 48 down to 54. And notice that A. King took a class or two and got an education credit, and he put that on line 50. And then because Wayne DeBeck, his son, is less than 17 years old, he gets a $1,000 tax credit. Now, what's happening with that? I have to go. Did they change that? And I have to go back and look. Did they change that? They were going to. There was talk of moving it up to 2,000, but I don't think they did that. I think it's still 1,000. So you add up your tax credits, and notice $1,100 gets reduced dollar for dollar from the $2,771 that we saw in the tax table. So tax credits are very cool, folks. We like tax credits. Why? Because they reduce your tax liability dollar for dollar. Whereas a tax deduction is cool, don't get me wrong, but it only reduces it by your marginal tax bracket. So for example, if you have a $100 tax credit, that reduces your taxes by $100. But if you have a $100 tax deduction, you have to look at what tax bracket you're in. In this case, he's in the 25% tax bracket. And you would reduce your federal taxes by $25, your California taxes by $6 or $8, depending. And so a $32 tax reduction. Tax credits are worth more than a tax deduction. Oh, by the way, there's never a reduction in Social Security taxes because they're not really taxes, they're contributions to a mandatory retirement system. So we saw that A. King was able to reduce his taxes by $1,100. So now we're down to $1,671. Okay? Let's go back to the slides and find out that there may be other taxes. But for the vast majority of people, no. If you're self-employed, this is where you put your Social Security taxes in, and this is where people like Timothy Geithner, the previous Federal Reserve Bank of New York chairman, and eventually the Treasury Secretary of the United States Treasury, screwed up. He didn't realize that when he worked part-time as a consultant that he had to pay Social Security taxes. And so eventually the IRS sends you a friendly little letter, official business only, saying you forgot to pay your Social Security taxes. This is where people who have nannies and other au pairs, household employees, have to pay the Social Security taxes for their employees. But for the most part, folks, most people will never be affected by these other taxes due. And of course, we take a look at A. King's 1040, and we find that he left this blank also. Whoa! Oh my goodness! So finally, line 63, we know how much taxes we have to pay. Now it's time to what? Now it's time to see how much money we've put into the system. And those are normally your withholding dollars that came out of your paycheck, and they are reported on the W-2 form, the little snitch that tells the IRS how much money you made, how much was withheld. All right? Now, the IRS has repeatedly said, and the courts have backed them up, that the withholding is a pay-as-you-go system. You can't just say, okay, I'll pay all my taxes on April 15th of the next year and go back and pay them all for the entire year. No, they're going to hit you with an under-withholding penalty. And we'll see where that is. It's in the 1040 form. I'll show you where that is later on. What typically happens is most people get a huge refund. And they say, but I like that big tax refund. I use it to go on vacation, or I use it to pay down my credit card bills. Well, folks, It's not a very smart way to do financial planning. You should do your best to estimate your tax bill so that they owe you $100 or you owe them $100. It's not easy. No, it's not easy, and that's why most people go overboard and get $2,000, $3,000, $4,000 tax refund. What are these two numbers? 90%, 100%. What are they? I don't know what they are, but they have something to do with estimating how much taxes you should pay, and maybe part of an answer to a question in an assignment for Chapter 3. I don't know. Do your best. If you're self-employed, then you have to pay your withholding. You have to pay quarterly estimated payments. And if you are one of those individuals who has a job where you get a W-2 and a paycheck, and a side business where you have to do Schedule C, in my humble opinion, I think it makes more sense to have more money taken out of your paycheck and then not have to do the estimated payments. Because if you do the estimated payments, the IRS assumes that you're going to continue to do them forever. And if one quarter you don't make any money and you don't send your estimated payments, they send you a nasty sounding letter saying, you didn't send your estimated payments. And you send back and say, but I didn't make any money. And they go, oh, we're sorry. And then if you don't do it the next quarter, they send you a nasty little letter saying, you didn't pay your estimated payments. So I've done that because I do have a little side business. I take more money out of my Southwestern college so that it pays that. Make sense? I hope so. And so how much did A. King have here? Let's take a look. He had $2,000 taken out of his paycheck. And then these are all the other places where you could have some payments made to the IRS. But again, most people will not see this. Here's the earned income credit. And what is that? People don't really understand the earned income credit. It's just one example of what is sometimes called, what is it? There's a name for it. But a reverse tax is basically what it is. We are saying to people who are in the poverty level and mostly have children, we want you to keep working. You're not making enough money, so what we're going to do is we're going to give you money. We're going to say, keep working. Here's money so you'll keep working. Sometimes call it universal income or something. It goes by various names. And it's going to hear more about it as more and more people's jobs are replaced by computers and robots and artificial intelligence, because people are not going to be able to find the work they did before. But again, if you don't file, are they going to call you up and say, hey, Judy, you didn't file, you're qualified for an earned income credit even though you didn't pay any taxes? No, you have to file to do that. And that's why you go to Southwestern College, VITA, Volunteer Income Tax Assistance, and if you are qualified for it, those trusty volunteers will find you money. All right. So, but in A. King's back, he makes more than enough not to qualify for the earned income credit. And so here he is, $2,000. He owed $1,671. So what does he do? On line 75, he says, I overpaid by $329, and I want you to send it back to me. Because what you can do is actually roll it over to the next year. I don't know who does that. I certainly don't do that. Give me my money now. Put in your bank account information. They'll send you a check, but they'd rather not. If you don't put this in, they might say, oh, she wants to roll it over. No, they won't do that. I don't think they'll do it. I don't know what they'll do. But here, if you did want it applied to 2018, that's where you'd put it here. Now, what if you owed money? What if this number were less than this number? You would put that down here on slide 78, and you have to write them a check, send them money. And if you had not had enough withheld, as we said on the slide, you might have a penalty. Now here's where Mr. Piano can help you, because I've helped individuals do this. If you are going to be hit with an underpayment penalty, you can send the IRS a letter saying, I'm sorry, I goofed. I didn't have enough money taken out. Will you forgive the penalty for this year? And every person I've done it with, every person I've helped do this, has been, the IRS has said fine. They didn't say anything. They just didn't send him a bill. So obviously they okayed it. I even had one person who did it twice. I told him, go down to your HR people and have more money taken out of your paycheck. You're not having enough money taken out of your paycheck. And he said, oh, okay. And he didn't do it. He came back next year. He said, oh, I didn't do it. So we sent another letter saying, ooh, I'm really sorry. And he did it. He finally did it that year. And the IRS didn't say anything. They never sent him a bill for anything, didn't attack him. So obviously it must happen more than they think. Right, indeed. And so where were we? Let's go back to the presentation. Right, so we have the withholding, estimated payments, all the other payments, whether we owe or not owe. So we're basically finished. Let's now go back to the 1040 form and finish up. We sign it. If you forget to sign it, don't send them another one and sign it. No, call them up. They'll send you what's called an affidavit saying, I goofed, I forgot to sign it, here's my signature, because you need to sign it. And now many people do electronically, date it, and sign it electronically over the internet. They want your occupation. Well, of course, A. King Back is a mattress tester. See, yes, indeed. This is what you're missing in the face-to-face class. Put in your phone number. They will never call you. I don't know why they ask you for your phone number. They will never call you. And so why do they ask for your phone call? I don't understand that. Why do they want your occupation? Well, think about it, folks. If you write down that you're a lawyer or a doctor, I don't know about you, but some lawyers I know don't make a whole lot of money, and then you say you've only made $20,000, they're going to think, what's going on here? We had a student, very colorful individual, who told me that he had spent time in the state correctional system for selling marijuana. He had lived up in Northern California and was a grower. Often when you're involved in the illicit drug trade, they get you for tax evasion. But this gentleman had run his business as a business, totally on the up and up, forgetting the part that the product was illegal, and filed his taxes. Now, what did he put down for his occupation? Cut flower grower. Did he lie? No, he did not commit perjury on his tax return. He was a cut flower grower. Very interesting, colorful individual. And, you know, he had, I guess, reformed. I don't know. That's a whole other discussion, whether or not marijuana should be legal or not. It's legal in the state of California, but it's not legal in the United States of America. So figure that one out. So, we're done. It wasn't that hard, was it? I hope not. Do it a couple more times, and you will say, I can do this. And then there's a second tax exercise for practice, and then there's an assignment. You can do it, dear students. Now, how do you avoid common filing errors? Check your arithmetic twice, right? Attach the necessary documentation. Don't make the check payable to the IRS. It's supposed to be made payable to the United States Treasury. Keep copies, proper postage, check everything again. And if you need more time, file an extension. Form 4868 might be even a question on on the assignment for Business 121, Financial Planning and Money Management. How much time do you get, right? What? Slide 31. If you find you made a mistake, should you A, leave the country, B, commit suicide, C, pretend it didn't happen, which is what a lot of people do, or D, file Form 1040X? Of course, the answer is file Form 1040X. In fact, if you catch the problem before they catch it, I think they'll be duly impressed. Remember, the IRS moves slowly, folks, but they do move. They do eventually get around to fixing things, and so if you find the problem, often it'll be to your advantage. You actually get some money back. Okay. Now, our last slide for today is the state of California. Oh my goodness! Now we got to do state of California. Well, once you've finished the 1040 form, you get to tackle the state of California's Form 540. Cute, huh? 1040, 540. But relax, it's far less than half the work, folks. There's usually just two forms that you have to worry about. There's the 540 itself and the 540CA, which stands for California Adjustments. What? In other words, there are some things that the feds tax that the California doesn't tax, and vice versa. For example, unemployment insurance. The feds tax that, but the state of California does not. The state of California does not allow you to deduct your state income taxes because you paid it to them, whereas the feds do. So that's pretty straightforward. After you've done the Form 1040, the Form 540. Oh, I can do that. And even though you've gone through this and said, you know, I can do this, wouldn't it be nicer if a computer could do it for you? Yes. Well, when we come back, we'll discuss resources and the fact that more and more people are doing their taxes electronically. And we will also discuss some tax planning strategies and finish up. So, was it really that hard? Was the 1040 form really that difficult? I hope you found that it is not that difficult. It's tedious, to say the least, and a little bit boring, should we say. But do it a few times, and you will be a tax expert and amaze your family and friends and coworkers. And next year, who knows, you might be one of the students who becomes a tax preparer through the Volunteer Income Tax Assistance Program. You can get college credit. Yes, and fabulous experience. Okay? We'll see you in our final presentation for Chapter 3, where we discuss tax resources, audits, and the like, and tax planning strategies.